If you're purchasing a new vehicle for your business, it is important that you not only understand how to do it, but also the tax implications of it. My name is Ethan Rushock, and today I'm going to be going through how you can purchase a vehicle for your business and claim it on tax. In particular, I'm going to be going through the basics, including talking about logbooks. I'm also going to be talking about how different business structures will affect your purchase and how you can claim it on tax. First of all, we need to understand the basics, and one of the first things that we need to understand is how much of this vehicle is going to be used for business purposes. So obviously, to claim a vehicle on your business, you need to be using that vehicle for business purposes. So the way we typically do this is via a logbook, and we need to do a logbook for a 12-week period, and this will then last us for 5 years. Now, obviously, it's a little bit hard to do this prior to purchasing a vehicle, but if you've got an existing vehicle you're replacing, you've got a good starting point to have a bit of an idea of what percentage will be used for business purposes. And this is really important when doing calculations to work out how much you're actually going to be claiming of your new vehicle and what will be the tax implications of that. So once you've done your logbook, this is going to give you your percentage of business and personal. So you might do a logbook for those 12-week period and you do 5,000 kilometers. And of those 5,000 kilometers, it might be 2,500 were business and 2,500 were personal. And therefore we've got a 50-50 use. So when we claim our vehicle, we're going to claim 50% of it. Your business structure will play quite a significant role in what you need to do to get all your paperwork in line and how you actually claim the vehicle. So let's first look at a sole trader, and this is our simplest of entities, which means our paperwork is relatively simple. If you're a sole trader, maybe your name's John Smith, and you want to claim your new vehicle, you're going to put the invoice in the name of John Smith. You will normally give your ABN, and they will normally record your ABN on the invoice as well. And when you register that vehicle, it's going to go in your name. There are a few things that you may have to tick. Sometimes on your insurances, you'll need to tick that's being used for business purposes, or even on your registration. But in general, everything's going to go in your own name because you as a sole trader takes on the same name as you as a person. Now, it's a little bit more complex if you're using a company. So if you are using a company, you will need to register the vehicle in the company's name. So you need to make sure you use the company's ABN when you're giving that to the person you're purchasing the vehicle. And again, when you register the vehicle and when you put your insurances, it's all going to go in the company's name. Now, this can be a little bit more complex because sometimes other entities just struggle to understand companies and trusts. So make sure that you get all this paperwork in line so that the company can claim the vehicle. Now, one of the key things here is it will be the company's vehicle, not your vehicle. So this can raise FBT issues, which is a bit too complex for this video, but it is something to keep in mind and have a chat to your account if you're purchasing a vehicle through your company. The other entity is a trust. And the tricky thing with trusts is they do vary slightly from state to state, but in general, the trust itself doesn't register the vehicle. That's because the trust isn't its own legal entity. So instead, the trustee of the trust is the one who normally puts the vehicle in their name. So from a registration point of view, it'll normally be the trustee that owns the vehicle. Now, from an invoice point of view, sometimes they will allow you to list the trustee as trustee for a trust. It just depends, but as long as you've got the trustee name is the key thing there. Trusts are definitely the most complex entity we have here in Australia, and sometimes it can be a little bit of a challenge to work out how it'll work. So it's really important that you understand how your structure works, especially with who the trustee is, how the trust is actually set up. And if you're not sure on that and how the vehicle needs to be set up, make sure you speak to your accountant about that. Now, if you're going through a dealer, then it is likely that they will be registered for GST, and therefore there'll be GST on your purchase, which if you're registered for GST yourself, this will have implications further down the line. If it's a private sale, it will likely not have GST unless you're purchasing it maybe from an existing business who is registered. So have a chat to the person you're purchasing to determine if GST will apply. When it comes to documentation, make sure you keep your tax invoice for the vehicle purchase. If it's a private sale, get something in writing. And then obviously you want to keep any loan documentation if you've got finance on your vehicle. Now, before I talk about how to claim it on tax, I've got the goal this year of hitting 10,000 subscribers on this YouTube channel. I'm almost at 4,000, so we've still got a long way to go till we get that ticking over. I'm going to be putting out a lot of tax-based content as we're coming into tax time here, so I'd love for you to hit that subscribe button. Now let's get into talking about how you can claim the vehicle on your tax return. So there's 3 things to consider when it comes to claiming your vehicle on tax. We need to look at what structure you're operating under, what is the business percentage, and are we going to breach the vehicle limit? So when we're talking about structuring, we've obviously already touched on sole traders, companies, and trusts. And each of these will be slightly different, especially when we're trying to work out what are going to be the tax benefits of this vehicle. So if we have a look at a sole trader, we can simply go, this will reduce our taxable income, and the tax savings are going to be whatever our marginal tax rate is. With a company, we know the tax savings are going to be 25%, which is the current company tax rate. So for instance, if we're buying a vehicle that is worth $50,000. It's being used 100% for business purposes. We're going to claim 25% of that, so it's going to be $12,500 in tax savings. For a trust, the tax implications are normally going to flow through to whatever the beneficiary's marginal tax rates are, because they're the person that would have normally been distributed this profit if we hadn't have claimed the vehicle. Now we're going to claim the business percentage of the vehicle. So this will come back from our logbook that we looked at earlier. We need to claim whatever the business percentage is. So if we've bought a car for $50,000 and it is 75% used for business, we're going to be claiming $37,500. Now there is a depreciation limit when it comes to cars. So this is currently set at $64,741. It does go up each year with inflation. So this is something to keep in mind because this is the maximum depreciation you claim you can have on a car. Now the ATO do have a definition here of what a car is. So that is, a car is a motor vehicle designed to carry a load of less than 1 ton and less than 9 passengers. The term car does not include a motorcycle or a similar vehicle. So if a vehicle doesn't meet that definition, then it is exempt from the depreciation limit. So it always pays to understand, is your vehicle a car or does it fall outside of that definition? Now there is also a GST limit of this as well, which is $5,885 for the 22-23 year. Again, this will change in the next financial year. So if we know all of that, then how does it actually get claimed on the return? Well, at the moment, we have the temporary full expensing measures, which allow us to claim pretty much all the way up to that car limit. So if we buy a $50,000 vehicle and it's 100% for business, we can claim that full depreciation in this current year. Now, these rules are changing from next year, where the instant asset write-off limit will come in, which is $20,000. So anything under that, we will instantly depreciate. Anything over that will likely get put into the small business pools, where we claim 15% in the first year, so the year of purchase, and then 30% in every year afterwards, of whatever our opening written down value is. So it's really important to understand how much is your vehicle going to be worth and what method will it fall under. Will it fall under some way where you can instantly write it off, or will it need to be depreciated over a number of years? Now the percentage we looked at earlier, the business related percentage, will flow through to all your other vehicle expenses. So for instance, your fuel or your registrations, your insurances or your repairs, all of those things will be claimed at the same portions as per your business related percentage. Now there is also the cents per kilometer method, but if you're purchasing a vehicle, it nearly will always be better off to use the logbook method, but feel free to do those calculations to see which method will maximize your claim. Now I did briefly touch on the instant asset write-off changes, and my upcoming video I've got talks about this in a much further detail, and it's really important to understand this if you're considering purchasing a vehicle. So I hope to see you over there.